Good morning, everyone. Peculiar place to be recording, but how does it matter? If you really want to communicate something, you can do it anywhere. Having said that, the discussion for today is on a particular question or comment that I got, and I probably had it before, but it's really worth explaining again, and will probably take you through the thought process that has been running through the mind over time, especially on the big picture scenario for the market. The near term, of course, we'll continue to monitor. I've already discussed in pretty much detail, I think, in the last video, what we are looking for in the index and how it relates to in the post-Fed environment. But in the big picture, somebody asked me at some point of time, we actually ended up marking a long-term wave 2 at the March 2020 lows. And why did I do that? It's an extremely short decline. Is it appropriate? It's a very good question. It has been explained in my last commodity cycle update, probably in one of the long short reports also last year. As we were trying to play with that opinion, we've kept it as an alternate count. Probably at some point of time thought of it as a preferred count as well. And the reason for that has to do with the economic cycles more than the wave structure itself, which we can always have an alternate. But the economic cycles were an important interplay. So if I just step back, what really happened after 2008-9, I was trying to assess our situation relative to the US. Much later, I realized that we continue to retain what is around a 8 to 10 year lag to what is happening in the US in terms of the economic cycle or the long wave. The long wave, of course, is Nikolai Kondratyyev's Kondratyev cycle, also known as the long wave. They're names for the same thing. What they refer to is a series of events that happen over 50, 70, or maybe even 80 years. In this case, we are seeing over 100 years, one after the other in the credit cycle. So one event follows the other. So you start with the spring where, things start to improve. You move into the summer, which is, after the big boom in spring. You hit a wall, you hit a pause. That's usually the longest period, 20, 30 years you can have a economic spring which starts from, ground zero, the initial enthusiasm of, value buying, a pullback, and then a long third wave of growth. And when you reach that end of that, the economy usually overheats and you end up in a period of high inflation and high interest rates. And so that's something which the US faced for the first time in the 1980s after its 40s and 50s boom. And we faced that in India after the 1970s and 80s boom. So in 1990, after the reforms, we actually ended up with very high inflation and then interest rates. So interest rates were almost running at 15% for those who don't remember. So our economic summer in the 1990s was almost more than 10 years after or 15 years after the US economic summer. But we have been trying to close that gap because we are quickly globalizing, we are quickly reforming and trying to, get touch base. But after what happened in 2008, which is the banking reset for the United States, India had actually not gone through a similar banking reset. So somewhere around 2011, I started to write about India's economic winter. And that simply meant that the excessive debt that we had created in the last cycle in the infra, capital goods and various sectors also needed to reset because India's credit to GDP had crossed 100% on a total country basis, which is including both public and private. So if you only take public sector, yes, you would say that is the government, you would say, okay, it's not as high as the rest of the world, which is still the case today, which is one of the positives. But when you added it onto corporate, because, when the government tightened excessive spending, talking about fiscal deficits, all of the booming years, which is in line with Keynesian philosophy that, during booming years, you tighten and during expansionary years, you expand. So we did that, but somebody had to spend, right? So who took on that baton? It's the private sector. The private sector borrowed more, spent more and grew all the way into 2008, 2011. But then various reasons, various sectors hit a wall. There was a lot of, talk about excessive land grabs. And so you needed a new land act. All of that started to happen, but it sort of slowed down an entire sector. And it also meant that a lot of the debt that had been taken on by sectors like power, infra, all hit a wall, and so you had a large NPA problem. Now, that didn't happen overnight. 2011, I just sensed it. 2015-16 is where Raghuram Rajan started to make it public, and so we faced the same problem the US did in 2008, in 2018, almost 10 years later. So we definitely tightened the time lag difference between our cycle and theirs. And of course, our cycle is not the same in terms of the levels of debt, but an economic cycle is an economic cycle. So actually speaking, India's peak in terms of stocks was 2018. That's where the mid-cap broad market indices peaked and started to fall. And so 2018 to 2020 was a long 2-year kind of bear market in stocks. But the thing is, for the first time, something that we witnessed had never happened before is a 2-year kind of lag between the Nifty and what the broad market is doing. Usually such intermarket divergences last for a couple of months, and then both markets sort of move in the same direction. We'd never seen that happen before. And that sort of became, one of the frustrating points in terms of seeing the cycle complete. So the Nifty just held on till 2020, till the pandemic. But it did form an ending diagonal pattern, something which we all technically recognize as an ending pattern to a cycle. It formed that, even though, you can say that the pandemic news was an outlier. Even then, the charts had this classic technical structure which looks like a distribution pattern. Unfortunately, the fall from 2020 is only a few months long, and therefore it looks like the 2020 bottom is, happened too quickly for a major cycle degree bear market, which is, you're saying you're ending a winter. So now that's the main reason. Why have I marked wave 2 at the bottom of 2020? Because we completed the economic cycle of tightening our debt problems, with the bankruptcy code, with the NPAs being written off, government providing funds to PSU banks. With all of that done, just like US did in 2008-9, you're sort of behind the point where we say you're in an economic winter. So you're transitioning from a winter to a spring. Now that transition, of course, requires you to bring the debt levels down, which doesn't necessarily happen unless you go through defaults. And if you don't, then the other alternatives, you go through a growth and inflation cycle, which brings it down, which is very, very akin to the 1940s. And that's sort of a lot of what, Ray Dalio started to write about in the post-2020 recovery phase, and what all this, there was this entire banking thesis around, they called it MMT, modern monetary theory. And what modern monetary theory simply meant is that it's not just central banks that need to intervene, because that doesn't necessarily result in growth. You're also going to need the government to step in and, spend. And the pandemic provided that opportunity. So when that happens, you'll get growth plus inflation, but the inflation will sort of bring down your debt to GDP. Now, the only risk to that is if you get excessive inflation, which is essentially what we are dealing with today. So when you're past the point where you've, sort of dealt with the private sector debt, and you're only left with the problem where the government is, basically private debt is transferred to the government, and now government needs to bring down its debt levels. That is the point at which we are transitioning from an economic winter to an economic spring. And that's probably why we would want to think as to when did wave 2 then really end, or wave 4, or whatever wave you want to mark. Basically, you're ending a super cycle, okay? So the wave marking is less relevant because it depends on how much data you have. US has 300 years of data, so Elliott Wave International marks the high as a fifth wave because it's a 300-year cycle ending. In our case, I say that the post-independent India is a first super cycle wave, which is a 50, 70, 100-year kind of bull run. I say 100-year based on that the RBI was instituted in 1934, just after the Great Depression in India. But of course, if you measure it from independence, we are only 70 years through. And so that's typical cycle for a one long wave to complete, which is why you want to complete wave 1 and wave 2 at the end where, debt problems get sorted out. And so that is why, but sometimes, the economic cycle itself and the wave marking can lead lag each other, which is the risk to putting a 2 at the bottom of March 2020. But that is a reason to do it and start considering it. So when we started to see a recovery in many of these sectors, which is infra, power, all of them started to, after 8 years of consolidating, they started to perform again in 2020, right? So that's usually the first wave of these sectors really coming out of a tough phase and starting to boom again, or at least starting to attempt to boom. Usually the first round of buying is value buying, where people start to sense, well, this cycle should come to an end. And then the actual growth happens. Now, I don't know where we are within that, but broadly speaking, you are trying to end a cycle. And that is why it fits with the idea of thinking that your super cycle second wave is over, because all of these sectors have already consolidated. Now, what can change this wave labeling to say that, okay, maybe wave didn't end in 2020 and it ends only in 22, 23, 24 with this ongoing next bear market. That would only be true if this bear market becomes deep enough. Deep enough means what? Deep enough means that you completely unwind. You revisit 7,500 or something like that, because that's how deep a second wave of a super cycle degree would have to be. Now you may say that, well, March 2020 wasn't that deep, so why too? But it was deep in terms of the overall market. If you actually look at a broader index or a mid-cap index, it sort of went back to the long-term channel lines which you draw all the way from 2008. And so it was pretty deep in terms of stocks. There were a lot of losses. So it is fair enough at that point of time to say that, okay, maybe we got somewhere because of that sharp decline. So it would take something of that nature to say, okay, the second wave didn't happen then, it's happening now. But if the current correction remains within, say, 38, 50% or even 61% retracement, I would like to think, along with what the sectors are doing, right? The sectors we said which are consolidating and breaking out after almost a decade of consolidation, I would like to think they are all in second waves, which means that this is a new super cycle for India, and the correction would only be a second wave, which is why it would retrace much less. It could be anyway, 38, 50, 61, doesn't matter. Whatever the retracement is, it would be a second wave in the long-term trajectory of a new super cycle that's going to last for 50, 70 years. So once we are done with that pullback, it's a long, long way ahead in terms of a growth cycle. So everyone who's projecting that is not completely wrong. The only issue we face right now over the next 6 months, which is why I am concerned, and so this is where people get confused when I sound more bearish. I'm not in the winter phase, right? Like earlier, where it was like everything's going to fall apart. It's more like this is the second wave is usually the deepest pullback of the cycle. So if anything deep has to happen, it can happen now. And even if it's not too deep, that's fine. But once you're past the second wave, the risk to assets, of any deep cut is usually behind you, and you're easily able to then project a multi-year move ahead, and it doesn't really bother you. So that's the transition I'm trying to make between the second wave and the third wave. At what point will it start? Some people are already trying to say it has started. I think looking at the global environment, it's an early call, and I'd rather be late than early, because it looks like, or it feels like, the second wave ended too fast, and so in this case you may say, okay, but it has been 1 year, but the June bottom was not exactly 1 year. It's in fact less than 1 year of the bear market if we take it from the peak in October of last year. We have seen a lot of corrections in individual stocks through rotation, so there's a fair case to say, okay, the stocks are bottoming out one at a time. Index doesn't matter. So these are all fair arguments. The last one standing is that, well, the global economy, because we are impacted by what happens in the US, even though in the near term it may look like, at least in September, October, we did not fall as much as the US. But if the US goes through another leg of a major downdraft, at the time it is falling, we will definitely be impacted. The extent of impact is the only thing which is changing, right? It was impacting us more earlier, now it is impacting us less. And so we get pretty enthusiastic about that idea that we are decoupling, but who knows what if the impact is more next time. So rather than make that judgment, I'd rather let it pass, and once the negative impact of whatever is happening in the US is behind us, it will be an easier call to say that the third wave has started. So I am trying not to preempt it. Some people are already calling it has started. I'd rather wait, because there are two macro factors that I broadly watch, which is interest rates and the currency, which is USD INR in India. So GSEC bond yields. So I'm saying particular to India, I'm watching GSEC bond yields and the USD INR. And if these two factors tell me that the worst is over, which is there's no more upside to USD INR, which is I don't think is the case. I think it's got a long way higher to go. And bond yields have not peaked in India, which also I think there's a lot of risk to upside in interest rates over the next 1 or 2 quarters. In fact, I really want to see the trajectory of domestic inflation data, which has been slowly picking up. We are just watching rest of the world inflation is higher, and we think India may koi problem nahi hai, because at 6-7%, we are used to it. Our long-term CAGR over 20 years on inflation is 6-7%. So at this level, we don't really worry. But what if the numbers keep peaking up? What if they keep stepping up higher and higher? The RBI will be forced to raise rates, much more than we are anticipating at this point of time. So I would like interest rate and currency risks to really be behind us before we, confidently call it the third wave started. And that's essentially the risk I'm dealing with. I don't have a problem with the 5 or 10 year view. If you're okay with a potentially, if not, it doesn't have to happen, but if it can happen, it's a risk to mitigate, which is a 30, 40, 50% drawdown. It's already happened in many stocks, which is why the call is become a weaker and weaker call. But the risk is not off the table because of the global and macro factor environments, that if something happens, that's a risk I want to mitigate. It's always easy to invest and ride a bull run at any point of time. I mean, for me, a move to 19,000 or 20,000 is not a bull run. That is trading. Okay, at 18,000, if you say index is going to 19,000, it's not even a 10% move. So anybody saying that this is a bull market and then only having a target of 19,000, that's really pathetic. You'd rather get your head examined, because at 7,000 or 8,000, if anybody got bullish and stayed bullish, you ended up at 18,000, right? So that's more than doubling of the index. That is how bull markets are. In fact, the start of 2002-03, the bull market index doubled within 6 months. That's what really happens in bull markets. Of course, that after that you got a correction, but bull markets move fast because everybody recognizes the growth cycle and then tries to jump in, leads to some near-term excess. There's a pullback, and then the bull market resumes. That's usually the cycle, and so 19,000, that's meaningless. I mean, if you say that the market bottomed at 15,000 and that the wave 2 is over, your target should be 30,000 and higher. So unless you're looking at that kind of number, and let's say you are looking at that kind of number, you're out there chest thumping saying it's going to 30,000, then what the heck? I can always get in at 19 or 20. I need to just be sure that there is no risk. So, after having ridden this market from 8,000 all the way till here, I'd rather be in capital protection mode than in a risk on risk taking mode where I should take all risks and not really bother about anything. That was my mode till last year. Right now, I've just taken that the world is going through something, and the only parallel, I think, if people want to draw a parallel, is draw it with 2001, because we went through the same thing. If you don't realize it, and I think I did, you go 2 videos back on YouTube and you'll find my video there. I've explained the parallels where many sectors bottomed out in 1998, but because of the Y2K bubble, we got 2001, in which many of those sectors only did wave 2. It's the same scenario. It's just a question of depth. That was a deep wave 2. Will this also be a deep wave 2? So far, it is not, and therefore people are beginning to judge it won't be. Last year, I thought it wouldn't be. I gave up in April on saying it wouldn't be too. It can be, and that is why I'm trying to mitigate that risk. So that's the scenario in my mind. A lot of parallels, but like we say, history doesn't repeat, it rhymes, and that's the situation between now and 2001. There are a lot of parallels you can draw. It's not going to be exactly the same, but the similarities are there in terms of the dollar, what it did, what you had in terms of inflation, and the sectoral behavior and the cyclicals, trying to attempt a comeback during the Y2K boom. And the unwind was really driven by global factors and not by domestic factors, which is essentially the problem that we face today. So I hope that sort of explains where we are in the quantitative cycle, attempting to enter a spring in the early stages, probably. And the early stages have that pain point, which is wave 1, wave 2. And wave 2 is the pain point of an early spring where you're just attempting to come out of a previous winter cycle, and then some headwinds show up, the sentiment turns bad, and then after that things start to improve. So between that is where we are struggling right now, between 2 and between 3 starting. That's it from me on this update. Until next time, thank you.